Hi, everybody. Welcome to Stop Being Sold, a community of informed consumers who are sick and tired of buying financial products that they don't understand or need. So if you are tired of being a transaction, go ahead and hit that subscribe button. And while you're at it, the like button if you like this content. My name is Michelle. This is Brian. How you doing, Brian?
Hey, doing great today, Michelle. How about yourself?
I'm doing good. So today we're talking about what the heck is an annuity. Right?
Great topic.
Everywhere, for me at least, it's like annuities. People love them or they hate them, and they really love them or they really hate them. So it's a very polarizing financial product.
It's a game changer, and it definitely is a topic of conversation. So
Yeah, for sure. So I'm gonna start asking some questions because you know a lot more about this than I do. So let's just start with what the heck is an annuity? What is it?
basically, it's a contract between you and an insurance company. Okay. And what it is basically you're taking your money, depositing it with an insurance company, and they either are giving you back a income off of the product on a monthly basis, quarterly basis, annual basis, whatever it may be, or you're sitting there putting it in there for growth. So the insurance company is paying you back for your funds.
Got it. So let's talk a little bit about, there's different types. So you want to run through what the type, let's just list the types, and then maybe if we can go into a little bit more detail because, there's variable, there's this, there's that, and let's just break it down for everybody.
Okay, so let's just hit the types to begin with. There's several types, okay? And look at it this way, whether you're looking for income, whether you're looking for legacy planning, protecting your spouse, you need a financial professional actually that can help you tailor it to meet specific goals. So again, annuities are sold. They're not bought. Have you ever hopped online just to buy an annuity, Michelle?
No.
No. Okay.
Not at all.
There you go. So let's take a look at this. Here's the main ones. Okay. A fixed annuity.
Okay.
A fixed indexed annuity. An immediate annuity. A multi-year guarantee annuity. And a variable annuity. That's 5 main types that cover 90% of all annuities out there today.
Got it. Okay, well, let's start with fixed annuities.
Fixed annuity. Easiest way to compare this is comparing this product to a CD in the bank. Okay, if you go to your local bank and you want to buy a CD, what they offer you is a fixed rate of return for a fixed period of time.
Right.
That's what a fixed annuity does. So a fixed annuity offers you principal protection and growth potential based on their rates. So people will shop fixed annuities just like they shop for CDs. So, and I will say in my long career in the business, 23 plus years now, I can't ever remember a CD rate being higher than what a fixed annuity rate was, if that makes sense. So it is a pretty popular product. Especially if you want a guaranteed rate of return for a certain period of time.
Specific amount of time, right? Okay.
And the longer, it's just like a CD, the longer you go in the time period, the higher the interest rate will be offered to you.
Got it. Okay. All right. So what about fixed indexed annuities?
Okay. Fixed indexed annuity. This one here, again, offers growth potential based on the performance of an index. So that'd be like, take for example, the S&P 500.
Sure.
So again, principal protection, because in a fixed index annuity, you cannot lose your principal investment. That's guaranteed by the insurance company, right? But the goal of this product is for allow you to get better growth potential.
Right.
Without the risk of investing completely into like the traditional S&P 500 index. So S&P 500 index, up and down, up and down, up and down, right? Well, if you go into this is based on an annual period. So you got a starting point. Let's say the S&P 500 is 3,000 today. 12 months from now, it's 3,100. You get a percentage, not the whole amount of what that actually returned in the annuity 12 months from now. So if you're used to seeing the ups and downs of the market every day, what you're not going to see is that in the annuity, because the annuity will only show you at the end of the period what your interest rate that you earned is.
Got it. And so with a fixed annuity, index annuity, is it also based on a specific amount of time?
Well, it could be. The longer the duration,
The higher the interest rate.
Yeah, 3 years, 5 years, 7 years, 10 years are the most common. The longer the duration, the higher the actual participation rate that you can actually earn more of the S&P 500 index.
Got it. Okay, and so real quick, just I'm curious, I'm sure everyone else is curious. So let's just take the fixed index annuity. If you do the 10-year one, right? At the end of the 10 years, you can put it back into another or a different type of annuity, pull out the money, you could do whatever. You're not going to be penalized if you allow your money to sit through the duration of the contract.
Right. And anytime, the goal is to longevity is the goal with any of these products that we're talking today, because of the fact that the insurance company will charge you a surrender charge for leaving the product shorter than the duration of it. So that's the big gotcha, I guess. But for some people, that's the trade-off of not losing their principal.
Right. So, but if that's explained very clearly up front, then you know as a consumer going into this that like, look, okay, if I'm going to take this 50,000, this 100,000, this 500,000, whatever the heck it is, then this needs to stay in for the duration of the contract. Otherwise, I will, there will be surrender fees.
Right. And legally, Michelle, that has to be explained up front. And the consumer has to sign off on that. And even when the policy is delivered, they have to also sign off again that they understand them surrender charges. And one step further on that, many of the insurance companies today, depending on the age of the consumer, will do random verification where they'll actually call the consumer after the policy is delivered and signed for to make sure
they understand.
Truly understands what they purchased, which is good. It protects the insurance company, that protects the consumer, and that protects the advisor. So you want your insurance company to do that it's just another level of verification that
understood
product and good to go for the consumer. Okay.
All right. So what about immediate annuities?
Okay. Immediate annuities. This one's pretty simple. This is for a consumer. Okay. So immediate annuities offer income payments that start right away or usually within the first year of you purchasing it. So this would be for a consumer that actually wants income off of their assets. So, so let's take, and this is one that, again, the whole annuity word is confusing sometimes. And you always hear, of course, we always remember anything in the news that's negative.
Negative.
Right. Positive, right? So one of the positives of the immediate annuity is if a consumer needs a specified amount of income for a certain time period. Okay. I've actually seen consumers use this for, let's say, when they're refinancing their home or buying a home. They will use some of their assets that, let's say their income's not high enough to meet the debt to income ratio to purchase this home. But they have assets over here sitting doing absolutely nothing that they can turn into an income stream that kicks out income to them on a monthly basis that the banks will use as mortgage verification as far as
And those income payments start right away? Is that what you said?
Usually within 30 days is how
30 days.
Yeah. So if you wrote the policy today, what's that? Today is October 19th. So you're talking November 19th would be your first direct deposit. So, or people will use this as something to create lifetime income that they can never outlive. Just like, so someone retires and say, you know what, I got this 401k here. And you're starting to see this, Michelle, inside 401k plans. There's now a section in there that says, this money will convert to X amount of dollars monthly for the rest of your life when you retire. So there's your lifetime income that you're starting to see today.
So with immediate annuities, there's a contract term, or is it until you die?
Well, you can have it for a specified amount of time.
Okay.
So imagine you had a 7-year car payment and you wanted this asset over here to pay out 7 years of payments to you so you can make your car payment.
Right.
So you could set that period. It's called a period certain, or you could set it up for lifetime. And one of the misconceptions of this is that the insurance company just takes your money and run with it if you die prematurely, right? All depends on the contract.
Okay.
Some of these contracts will allow you to have remaining funds go to your heir.
Pass on.
Everything's
Right.
a contract. So just remember that to read the fine print of every contract and make sure you ask the questions.
Yeah, and this is one reason, in my opinion, that they are confusing, because it is contract based. It's based on what you need, where you are now and where you want to be, right? And so if you just show up to somebody and say, "I have this money, I don't know what to do with it," they're like, "Hey, annuity one, go for it," and you're like, "Oh, okay." Right. And then it can be confusing because it is contract based. Right. And so this really know what you're getting into, know the different types and ask questions about, hey, why did you offer me, if you're speaking with a financial advisor, I'm going down a little rabbit hole here, but, you're speaking to a financial advisor and it's like, you're like, I have this money, and they're like, the person is like, fixed annuities. And you say, well, why that? Why not immediate? Why not variable? Why not this? Why not that? Right. And just being able to at least give the dictionary definition. Right.
You're exactly right. And again, when you're sitting with an advisor, make sure you truly understand and truly explain what your goals are.
Right.
With the money, because that will help a fiduciary understand that, look, here's the best product based on what your goals are, not just sell you everyone the same product, because that doesn't work. So.
Right. Got it. Okay. So we've talked about fixed, we've talked about fixed index annuities. We've talked about immediate annuities. What is the next type?
Okay. Let's go to what's called a Myga, MYGA annuity. Mm-hmm. And what that is a multi-year guaranteed annuity. Okay. This is very similar to a fixed annuity. And basically it is the same thing as a fixed annuity. So like back in the day when interest rates were much, much higher, we could do like 5%, 6% guaranteed for 5 years for a consumer. And now, so you're looking at now, you maybe 2.5% for 3 years, 5 years, around there. So they fluctuate quite often, but that's a Myga. It's just like a fixed annuity, but it's designed again for, I want 5 years from now, know exactly how much money is in this account, or a 10-year Myga. You'll see that shopped more often. The fixed annuities and the Mygas will be shopped online quite often.
Okay, so I'm sorry, you said they're very similar. So what is the actual difference?
Just the name of them. And some companies will say, here's a fixed annuity. Other ones will say, here's a Myga. Well, the fixed annuity also, some fixed annuities allow you to convert it into a lifetime income, where some of them don't. So that would probably be a big difference between the two of them. But it all just depends on the company, what they call them, what the name of the product is with each company, and how their contract is based. So just look at them together as a Myga and a fixed annuity are very similar, but look at the different companies to see what the differences are.
Okay. So thank you for that. So the last one, variable annuities. Let's talk about this.
Annuities. This is the one that I see quite often. And this is for, so kind of like the indexed annuity. Remember how I told you the fixed indexed annuity offered the growth potential based on an index like the S&P 500? This is similar, except for in the indexed annuity, you cannot lose your principal even if the market drops.
Right. Got it. Okay.
The variable annuity, this is an actual investment product. So this means it is actually tied to the stock market in one form or another. Stocks are in there, bonds are in there, mutual funds are in there. So it's kind of like your 401k. You still got a lot greater growth potential, but you also have different levels of risk inside this product.
And there's no guarantee, you can't, in a variable, that it's not guaranteed that you won't lose your principal.
You're exactly right. You can actually, out of all the products we just spoke about today, the variable annuity is the one that you can lose your principal inside.
But you can also, I mean, it has a greater risk, but it also has a greater reward. Is that not accurate? Or the potential for a greater reward, I should say.
Yeah. So there's a trade-off there of, so if you got a consumer that is saying that, oh, I want growth. Well, I don't want no risk though. Well, then the best solution for that consumer is zero risk, but I want greater growth potential of everything we spoke about today, is the fixed indexed annuity would be the better option. Now, if the consumer says, I can handle some risk, but I want to trade off that level of risk for a much higher growth potential, then you'll look at the variable annuity portfolio.
Okay. All right. Makes sense. So with the variable, does that the same thing as all these? They have a contract duration, correct? You select it.
Yeah, you have to select the contract duration. Plus, one of the differences with the variable annuity from all the other products listed here today is that with a variable annuity, your advisor has to have 2 licenses, not 1.
Mm.
So
what are those licenses?
So number 1, they have to have an insurance license to market any annuity.
Right, because it's an insurance-based, yes.
It's an insurance-based product, right. Now with the variable annuity, you have to have your investment securities license also, whether it be with a broker-dealer.
Right, because you're dealing in securities. Makes sense.
You have to deal with securities to be able to offer a variable annuity today.
Okay. All right. Makes sense. So I just have, if it's okay, I just have a few more questions. I think this is actually, on that note, if you're liking this content, please give us a like to other people get content like this. Yes. Hit that little like button. And also make sure you subscribe so you don't miss another video from us. We don't always talk about annuities. That might get boring, although this is quite fascinating. I'll be real honest with you. Okay, we have these, we have let's go over it. We've got fixed index, immediate, is it Myga? Myga, and variable annuities. So one question that I have is how, like, if you've got a pocket of, like, let's just say you're retiring, you want to roll your 401k over, you don't want to put it in IRA, you might want to put it in annuity, you're looking at all these options, or you've been given I know few people that I know have received large inheritances or small, like 20,000, 30,000, and some of them even higher, who are like, okay, what am I going to do with this? Or sold a company and they have a large chunk of stuff, how does one, like, what is your advice other than just understanding the difference between these? Like when someone's speaking to a financial advisor and they are offered an annuity, like how do
how do I determine the difference, or what?
No. I mean, I guess as a consumer, so I've got a chunk of change. It doesn't matter if it's 20,000 or if it's whatever it is, and you're speaking with a financial advisor who's hopefully a fiduciary, right? And who legally has to put your interest, above theirs and above anything really. But how does one go about, determining which type of annuity might be right for them?
Michelle, that's a great question, because it all comes down to what the word depends.
Mm-hmm.
Okay. Because it all depends on, first of all, you got this chunk of money. What are you trying to do with it? What are your personal goals with it? Okay. And you mentioned someone retired. Okay. So somebody that's retired maybe say, look, maybe they're moving from the accumulation phase of their assets to the withdrawal phase because they're no longer working. They need income off of that. So again, it's a big gotcha question.
Sure.
Because of the fact that every person is different. So, and for example, a question I would ask is, okay, so you've got Michelle, you came to me, you just retired, you've got your Social Security income coming in, you've got a small pension coming in. What are your goals with this 300,000 today? And you'd come back and say, well, I just want to, I'm a little leery of the stock market.
I don't want to lose my money. I want to protect my money.
That is so common, especially.
Right. Well, yeah.
Sure. But at the same time, you also say, I still want some growth. So then you've, as an advisor, you got to look at your big portfolio, shop all your companies and find the best product or products. And usually it's products that fit that scenario. And so if you truly want growth, and you're willing to take a little bit of risk, why wouldn't you use something like the stock market over here and maybe an indexed or a fixed annuity over here to put some guarantees in place, knowing the fact that you won't lose your funds over here on the annuity side, the fixed side. And then also, why not go to the stock market with some of your funds? And so
you can have different types of annuities at the same time, right? Okay.
You can have multiple. So you could say, look, I need X amount of income coming in on a monthly basis, but then I want growth over here. So again, it truly comes down to the individual that the advisor is sitting in front of and what they're trying to accomplish. So when you get to retirement or you've got this lump sum of money and you're looking on what to do, you truly, to do what's best for you and to truly help the advisor that you're sitting with, you as the consumer need to define clearly what you want done with your funds.
Sure. Well, I was just saying it really goes, it falls back on the consumer to ask himself or herself the right questions, not just like, what do I want to do with this? I want to make money. No. Like, what you have this, where do you want to be with it? What do you actually want? And if you're not certain, like, that's okay, right? Like, you could do different scenarios. So it falls on us as the consumer to do the research and to get clear with where we are and where we want to go and what we, and also the risk tolerance. Like, what are you willing to lose?
Right. Risk tolerance today. And think about this. Say you got consumers that say, hey, I only want 20% of my money in the market. That's okay. We understand. That's a good thing. And you put 80% to the safe side, or a common concept is 70% fixed, 30% in the growth side. So Michelle, let me ask you a question. If you had $100,000 at retirement, and you or a lump sum of funds right now, and you said, look, I want 70% of it in the safe money that can never lose no money, right?
Right.
And over here on the right side, you said, I'm 30% at risk. Okay, so let me ask you something. If the market dropped 20% on your portfolio and you've got 70% on the safe side, 30% in the at-risk side, how much money did you lose?
I'm sorry, there's something going on outside my window. Wow, there is a car that has not let off the horn. Okay, so you're going to have to ask me that again.
Okay, so your $100,000 portfolio.
Yep, got it. And I only want 70%. I want 70%, like, don't touch it. Like, I don't want to lose anything. Mm-hmm.
Right, and 30%, you want to put it in the market.
Sure.
If the market dropped 20%, how much are you down on your portfolio?
I don't know. I don't do math.
30% times 20% is 6%.
Okay.
Out of 100,000, you're only down $6,000. Is that better than having the whole amount in there being down 20%? Okay, so here's how you split it up for your consumer. If and everyone's different. Their risk tolerance are different, and some people. Yeah, I had one last week said basically, look, I want 10% at risk. So 90% of their portfolio is going to be safe money assets.
Mm-hmm.
So there's what you do with your consumers. And again, personal preference. How comfortable do you feel with the stock market today? So
right. Absolutely. Well, this has been really informative. Thank you for doing the math there for me. Thank you, everybody, for watching this. Again, if you like our content, we'd love the thumbs up and also subscribe so you don't miss anything else from us. We don't just talk about annuities. We talk about 401k rollovers, Social Security, just really anything, any type of financial product that, that you might not be certain of.
Soon, Michelle, we'll be doing actual reviews of individual policies out there and companies to give you a better understanding of these type of products if you're out there searching to buy them or an advisor is trying to sell them to you.
Awesome. All right. Well, thanks, Brian. Thanks for everything. Again, hit that like button and we really appreciate. Brian, thanks for your expertise today. I know a lot more about annuities than I did a few minutes ago. So thank you very much. Have a good one.
Bye-bye.